But it would be foolish to say that there aren't smart people sitting there with targets in mind and waiting for some semblance of stability to reappear in order to rebuild portfolios for the next phase. But they're not the dominant ones, are they? The dominant ones are the guys who are panic markets. People always say market comes down on profit taking. It comes down on loss realization. And the guy who sells at the top, but then sells to the next two guys who realize it's not going to hold, who sell to the next guys. And if any of those are leveraged, we're in trouble. And if they're losing a lot of money in one market, which might be somewhat peripheral to the real thing, there's another old expression, pulling up the flowers to water the weeds. You sell the other thing to pay your margin calls or to get to try to reconstitute your finances. So it can spread, and we're clearly in that phase at the moment.
So the question really at this stage is whether the market is over-leveraged. What do you think?
Well, if we look at the period from just before COVID hit, nearly 3 years ago now, 2019, we had, I think it's about a 45–50% rally in the broad stock market, maybe 65–70% in the tech stock market, and of course, untold percentages on top of that for the meme stocks and the hot stocks and the favorites, and they're all crashing back. But we're still 10–15% above where we were before COVID hit. Now, you can't tell me that the world's in a better place now than it was then. So even people who are trying desperately to convince themselves that somewhere down here they must now be valued just because the asking price is lower, are possibly still deluding themselves.
Sean, if we take a look at the behaviour out there, some of the retail investors, though, see these big name stocks, some of the meme stocks well and truly off where they were trading. They think, well, if I buy these now and hold for the long term, then I'm not going to be losing money. Quite a different view from what we're hearing from the big institutions. They're saying we just need to cut some of our positioning. We were overweight equities pretty much across the board, and now we're going back to neutral, in some cases underweight. How long does this take to flush out till the market on the institutional side becomes more confident and flips back perhaps to where the retail side has been, given that there's been this buy the dip mentality for so long?
Well, I don't know. I mean, clearly institutions are in the business of putting money to work. So at some point they've got to buy something somewhere. But we have a world where every time you turn on the news or fire up your computer, there's some more bad news, whether it's in terms of inflation, whether it's in terms of supply disruptions, whether it's in terms of the war, which threatens to spread from Russia's borders. And on we go. We have problems with energy, we have problems with food, we have problems with all the staples of life. Is this a time you're worrying about spending $2,000 to buy a cycle to pedal away in your own home? Well, clearly not, which is why Peloton has been crushed. But how many other types of companies like that are now somewhat superfluous to the basic problems of existence with which we, for the first time possibly in 2 generations, have been confronted?
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.